Good afternoon, everybody, and a warm welcome to Winning Strategies. I'm Cindy Bishop with Cindy Bishop Worldwide, and it's a pleasure to introduce our esteemed master instructor for today, Kelly Catalinas. She's with Fairway Independent Mortgage. Now, let's turn our attention to Kelly, a seasoned mortgage loan officer with over 3 decades of experience. Kelly has not only excelled in her career, but also has become a leading lender and branch manager. Her expertise extends to training agents and lenders, enhancing production, and cultivating lead generation. In recognition of her outstanding contributions, Kelly has been honored to receive the Lifetime Achievement Award by Washingtonian Magazine. Additionally, she has received the Five-Star Professional Award for the fourth straight year, which was bestowed upon 3 out of 4,600 individuals in the Washington, D.C. area in 2024. And that's not many. 3 people out of 4,600. This goes to tell you who's getting ready to do this webinar. There are just some, these are just some of the many professional awards that Kelly has received that we mentioned here. What truly sets Kelly apart is the trust and admiration she's earned from her clients and agents, with over 95% of her business coming from referrals. Today, Kelly will share her expertise on this special winning strategy program series. Without further ado, please join me in extending a warm welcome to Kelly.
Hi, everybody. Thank you so much for joining me today. I'm having some issue with my presentation here, so I can't see you right now as I progress through. So if you have any questions, just unmute. Feel free to do that. Cindy, if you are using chat, if you could just monitor it for me and just interrupt me as we go. It is my pleasure to be with you today to discuss buy before sell strategies. And we basically have come into a place, and I know this is not unknown for you right now, where inventory is very low, moving expenses are very high, and people do not want to move twice. You know, they might have issues with qualifying as interest rates have gone up. So they would really like to be able to offer a non-contingent contract on the next home that they're buying. Well, how do we do that? Okay, today I'm going to discuss a few different strategies with you, and I'm going to preface it before I jump into the first one, which is HomeLight, where let's say your borrowers are in the conforming loan range, like the Fannie Mae or Freddie Mac conforming loan range. It's a little known fact that if they were to purchase something on a new home, but they had a guaranteed offer on the current home, Fannie Mae and Freddie Mac will let the lender discount that payment when qualifying them for the new home, right? So as a result of that policy with the agencies, and I'm only talking conventional here, you've had these companies pop up and say, we're coming into the market. We will do a guaranteed offer on the departure residence. We may be able to provide bridge funds. Some companies will provide the bridge funds or equity on the current house, so the borrowers can put that down on the new house. Other companies will not provide the bridge funds, but would just provide the guaranteed offer. Okay, so the first one I want to talk about that's gaining a lot of traction is called HomeLight. Okay, they offer what's known as a modern bridge loan solution. They do an evaluation on the departure residence, and they calculate how much equity they are willing to unlock, okay, on that on the departure residence to be made available for the purchase on the next home, okay. They'll do Fannie Mae and Freddie Mac programs, obviously. The borrowers may be able to borrow up to 75% of the value of the departure residence and take advantage of a 0% interest rate on that bridge loan unlock. And this can be used to eliminate that sale of home contingency. I sat on a class with HomeLight 2 days ago, and they are expanding in some cases that access from 75% up to 85%. It depends on credit score, it depends on reserves. So there's a little bit more involved there, but you may be able to get even higher than the 75% now. okay? So here is how it works. If someone is interested in this program, the person with the departure residence will work with me, and we will send in some qualifications to HomeLight where they can pre-qualify the client within 24 hours or less. We submit them some basic information on the departure residence, address, name of the borrower, etc. And they will look to see how much equity they can unlock in terms of access to those funds in advance of selling that home. So once they're pre-qualified, the client and the agent can start making stronger offers. You wouldn't have a home sale contingency. You would close on the new home purchase, and you would be using that unlocked equity as down payment, closing costs, whatever. Then the old departure residents can sell their home as usual. Okay, so they move into the new property. They have a timetable with HomeLight in which they need to sell the home. You, as the realtor, can list the property for them, and typically it's a 90 to 100 day timetable in terms of selling the home. This helps to reduce the debt to income ratio, so it makes qualifying for the new home easier instead of counting both payments, not, and trying to get a non-contingent approval. That might not allow them to go as high as they need to. So this is a good solve to negate that big mortgage payment on the departure residence. And what does this cost? So it's not inexpensive for HomeLight. They charge 2.4% of the sale of the departure residence as their fee. We do submit the client property through HomeLight's lender application, which is a link that I have, and we go through that. They will unlock equity for homes up to $2 million. The property has to be between 750 and 5,500 square feet and on up to 2 acres of land. Okay, so there are some parameters there that it can't exceed in terms of the property. They do provide that 90-day backup offer on the departure residence, which is the combination of the existing balance on that old loan plus whatever they've unlocked on the bridge loan funds. Okay, that's their offer. If the client's home is not sold within the 90-day period, right, of going to settlement on the new home, HomeLight can purchase it. If they purchase the home, the client who owns the departure residence will receive any excess funds less the 2.4% program fee and any additional costs that they incurred while they marketed and sold that home during HomeLight's ownership after it resells it on the market. So the point here is, as real estate agents, you need to sell that home in 90 days. That would be my ask, right? To protect your client in terms of getting as much for that property as possible. Okay. But just remember, in addition to your buyer broker fee, there would be that 2.4% cost of this program out of net proceeds back to HomeLight for using this option. Okay. Any questions on that before I move to the next program? And we have more information on this I can send out if you need it. We have flyers and things like that. But if you have any clients that, really need to sell first and have those monies to move to the next property and don't have the option of moving in with mom and dad or a relative or short-term housing, you would want to look at the cost of moving twice and compare it to that 2.4% fee. Right? So that's one of the strategies in terms of thinking of this program. Okay.
Is HomeLight program in Virginia or Maryland and DC as well?
It's in many states. I don't know that it's in all 50 states yet, but it is in DC, Maryland, and Virginia. Yes. Okay, so let's just encapsulate HomeLight. HomeLight is the program that you would go to if you need the funds in advance of selling the house. This is the client that needs those down payment funds out of the house and wants to buy before sell. Okay. The next program is called the trade-in mortgage powered by Calc. Okay. Calc provides a guaranteed backup offer on the departure residence. They do not provide bridge funds. So this is perfect for that client who has enough to put minimum down payment and closing costs on the new home purchase. They just need to negate the payment so they can qualify for the new home. They don't necessarily need the funds today. You know, they might be able to go 5% down on the new home purchase and cover their closing costs and their buyer broker fees without having to unlock that equity or take a bridge loan. So as a result, this option is less expensive than HomeLight because all you're looking for here is a guaranteed offer so we can negate that payment. Okay. So with this purchase price guarantee, I'm sorry for my dog. Come here. Buyers can list homes with the most competitive asking price. Excuse me 1 second. Get over here. Sorry, Cindy, that'll do great on the recording. With their purchase price guarantee, the buyers can list the homes with the most competitive asking price. And if it doesn't sell within 120 to 150 days in most markets, Calc will purchase it for the agreed upon sales price. Okay. The costs for using the trade-in mortgage is a flat fee of $2,000 to Calc plus 1% of whatever the purchase price guarantee is that they arrive at on that departure residence. So clearly less expensive than HomeLight. And, you know, if they still needed bridge financing, the borrower can go out and find their own bridge financing, or they can come to us. We have a bridge loan here at Fairway. As long as I'm doing the first trust mortgage, I can also possibly do the bridge in conjunction with Calc. Okay. They won't let me do a bridge unless I have the new first trust. Okay. So this one clearly less expensive, does do that guaranteed by and very easy for them to apply for this if they want to use it. The good thing about this one, again, when I'm screening that loan for eligibility, do they have the minimum needed for down payment and closing costs? And then let's negate the mortgage and get them qualified. Okay. All right. So we use Calc a lot with our own in-house bridge financing. If I'm working with a borrower and I'm pre-approving them for a new home purchase and they don't have those funds and they really can't qualify carrying both payments and really want to be pre-approved for as much as they can be approved to for the next home that's needed, we will often pair a bridge loan on the departure with pre-approving them for the new home purchase on the forward side. Okay. So a little bit about our bridge loan here. We will combine it with Calc. And here are some of the features and benefits. Again, it's only available if we are working on the new purchase loan in process for the buyer. The bridge loan can be a first or second lien on the departure residence. Sometimes you have a departure residence that doesn't have a loan on it, but even with the taxes and insurance on that property being assessed against the buyer, it impacts their qualification power on the new home purchase. Okay. So the bridge can be either first and second lien position, primary residence, single family detached, because we are not doing this on condos right now. Okay. So there are some property restrictions that apply, and we can check that once we know the departure residence characteristics. It is interest only payments 5 months of interest-only payments, and the borrower will qualify using the interest-only calculation. And then it's balloons in 6 months. Okay, so the bridge loan has to be paid in 6 months. So the bridge funds can be used for down payment and closing costs and reserves on the new primary resident purchase transaction. And this bridge loan is a balloon loan, right? It's due at the end of the 6th month or whenever that departure residence is sold, whatever occurs first. Okay. A little bit more about our bridge. We need a credit score of 660 for loan amounts up to 100,000 on the bridge. 680, we will go to 150. 720, loan amounts will go between or higher will go between 150 and 300,000. We have a max debt to income ratio of 50. But if the debt to income ratio is greater than 45%, we need a credit score of 740. And then additional requirements apply. Again, you're going through the standard Fannie Mae and Freddie Mac qualifications. So if there's something that the agencies require, it would be required on the bridge documentation as well. And that's really what I wanted to chat about today. HomeLight, trade-in calc mortgage, and then using it in conjunction with a bridge loan. The key factors here to take away, it will strengthen your offers if you can get this done ahead of time. So you could write a non-contingent contract. It's very easy for us to check with either HomeLight or Calc to see what's available to the borrower on the departure to help them make that decision, if that's a good decision for them, and tell them how they can get started on that. Any questions anybody has on anything that we discussed today? I think, we can see that there's obviously, I think, a need for this. We have to come up with new strategies for people to get into the homes that they need to get into instead of settling for a stepping stone home right now in a very low inventory market. And again, try to avoid moving twice if you can, right? They want to get top dollar for that house once they vacate it. And sometimes with families, you can't really get the work done on the house for you to stage it properly until they're out of it. So I think it's a great solve in our marketplace right now as we're in this lower inventory environment.